Did you know that the average annual return of the stock market over the past 100 years is about 10%? Yet, most people still don't take full advantage of it. Shockingly, nearly 70% of Americans have never invested in the stock market at all. That means they're missing out on the power of compounding, the magic that turns small investments into huge wealth over time. Peter Lynch is a name that everyone interested in investing should know. As the legendary manager of the Fidelity Magellan Fund, he turned $18 million into $14 billion. Yes, you read that right, $14 billion. But here's the kicker. Lynch didn't use insider information or secret strategies. He did it using simple, everyday investing principles that anyone can follow. In this guide, we're going to break down Peter Lynch's most powerful strategies. From investing in what you know to finding those hidden gems in the stock market, we'll show you how to start thinking like a successful investor. So, if you're ready to turn your money into more money and stop letting opportunities slip through your fingers, keep reading. You might just be sitting on the next big stock market win, and you don't even know it yet. Chapter 1. The Magic of Invest in What You Know. Peter Lynch's genius strategy. Peter Lynch's investment strategy is rooted in a simple yet powerful principle. Invest in what you know. This means investing in companies or products you already understand and use in your daily life. Lynch often said, if you're not willing to do research, don't invest in the stock market. But this doesn't mean you need to be a stock expert. Instead, observe the world around you. If you're using a product or service and it's helping people, that could be a signal of a potential investment opportunity. For example, Lynch famously invested in Dunkin' Donuts because he loved their coffee, and he knew many others did too. The beauty of this strategy is that it gives you an edge. You don't need to be a financial analyst to notice when something is special. Think about companies you interact with regularly, whether it's your favorite restaurant, an app you use every day, or even a product that seems to be trending. As a consumer, you have a unique perspective that Wall Street analysts don't. By investing in companies you understand, you can make more informed decisions and feel confident about your choices. Research supports this idea. According to a study by Morningstar, investors who are familiar with the companies they invest in tend to outperform those who invest in businesses they don't know well. So, the next time you see a product or service that excites you, think about how many other people share that feeling. It could lead you to your next big investment. Chapter 2. The Hidden Gems. Finding undervalued stocks like a pro. Lynch was a master at spotting undervalued stocks, or hidden gems. These are companies whose stock prices are lower than their true worth, often due to temporary issues that the market overreacts to. One of Lynch's best pieces of advice is to focus on companies that have solid fundamentals, but are trading below their potential. The key to making money in stocks is not to be scared, he once said. You have to find the undervalued stocks, the ones that the market has missed. To find these gems, Lynch recommended starting with a simple rule. Look for companies with a price-to-earnings (P/E) ratio below the market average, but with strong earnings growth. A P/E ratio that is too high could mean the stock is overpriced. But a low P/E could indicate the market has undervalued the company. According to Lynch, a company with a low P/E ratio and strong earnings growth is like a diamond in the rough. But it's not just about numbers. Lynch also encouraged investors to dig deeper into a company's story. What are the company's competitive advantages? Does it have a solid management team? What's its long-term potential? Investors who rely only on surface-level data miss out on the true value of a stock. In his book One Up on Wall Street, Lynch shared his own experience of finding an undervalued gem in a company called Fidelity Magellan Fund in the 1980s. With the right research, he turned that investment into a multi-billion-dollar success. Statistics show that undervalued stocks tend to outperform the broader market over time. In fact, a 2020 report from Credit Suisse found that value stocks outperformed growth stocks in the long run, especially when market conditions favor economic recovery. By finding those hidden gems, you're positioning yourself for greater potential returns, while also reducing the risks of overpaying for a stock. Chapter 3. The 5 key rules every beginner must know. Avoid the rookie mistakes. If you're new to investing, you might be tempted to follow the crowd or chase quick profits. But Peter Lynch believed that sticking to a set of key rules would help you build wealth in the stock market. Let's break down 5 essential rules that every beginner must know. 1. Do your own research. One of Lynch's strongest principles was that individual investors should never rely solely on experts. 1. You have to be your own expert, he said. 1. Lynch believed that by researching a company thoroughly, you could make better decisions than most professional analysts. 1. This includes looking at financials, understanding the company's business model, and assessing the management team. 2. Think long-term. Lynch was famous for saying, the real key to making money in stocks is not to get scared out of them. 2. Investing is not a sprint, it's a marathon. 2. Many beginner investors panic during market dips and sell too early. 2. But the stock market rewards patience. 2. Historically, long-term investments have outperformed short-term trades. 2. Lynch famously held onto successful stocks for years, even decades. 3. Invest in what you understand. As we discussed earlier, Lynch's approach was to invest in companies and industries you are familiar with. 3. If you know a product inside and out, you're in a better position to judge whether the company behind it is a good investment. 4. Avoid the hype. Many beginners get caught up in hype or hot tips they hear from friends or social media. 4. Lynch's advice here is clear. Don't buy a stock just because it's trending. 4. Look at the fundamentals and make sure the stock has long-term potential. 4. This will help you avoid the common mistake of chasing stocks that are overhyped but lack real value. 5. Diversify your portfolio. While it might seem tempting to put all your money into one stock that you believe will make you rich, Lynch advises against putting all your eggs in one basket. 5. Diversification reduces risk and increases your chances of finding winners. 5. A well-diversified portfolio can help protect you from losses if one investment doesn't perform as expected. By following these simple but effective rules, you can avoid the common rookie mistakes that trip up many new investors. The stock market can be intimidating, but Peter Lynch's approach makes it approachable for anyone willing to put in the effort and stick to these key principles. After all, as Lynch once said, the stock market is filled with individuals who know the price of everything, but the value of nothing. Don't forget to subscribe to the channel for more investing tips and strategies from the best. Chapter 4. The Power of Patience. Why time is your best friend in investing. One of Peter Lynch's most powerful pieces of advice is the importance of patience in investing. He always said that time is your best friend when it comes to the stock market. In his book Beating the Street, Lynch emphasized that the longer you hold onto a stock, the more likely you are to see it grow. It's about waiting for the right moment and not rushing for quick gains. Lynch didn't chase short-term profits, instead, he focused on the long-term potential of his investments. The key to making money in stocks is not to get scared out of them, he once said. Lynch's approach isn't just about holding stocks for years, it's about letting the company grow and allowing your investment to benefit from that growth. Many people make the mistake of selling stocks too early, often out of fear when the market dips. But, historically, stocks tend to bounce back, and if you stay patient, you can earn significant returns. A 2019 study by Vanguard found that, over a 20-year period, the stock market consistently delivered an average annual return of about 7% after inflation. This shows how powerful patience can be when investing for the long term. Lynch himself held on to some of his best investments for decades. One example is his investment in Fidelity Magellan Fund in the early 1980s. He didn't sell after a temporary dip, and that patience paid off when the stock surged, turning his investment into billions. The lesson here is simple. Let your winners run, and don't get discouraged by short-term fluctuations. The power of compounding, the longer you stay invested, is remarkable. As Lynch once put it, you get the highest returns over time by being patient and investing in good companies. Chapter 5. The 10 Baggers Secret. Turning small investments into big wins. Peter Lynch popularized the concept of the 10 bagger, a stock that increases in value by 10 times its original price. Finding these kinds of stocks was one of his main strategies. He believed that the real key to making money in stocks is to buy a good business at a reasonable price. When you identify these 10 baggers, you're sitting on an investment that could drastically change your financial future. Lynch wasn't looking for ordinary companies, he was after companies with high growth potential that were still under the radar. These could be smaller companies with innovative products or services, or they could be established companies that were temporarily undervalued. He recommended looking for companies in fast-growing industries, like technology or healthcare, and focusing on businesses that had the potential for explosive growth. "You don't have to be a genius to pick the winners," Lynch once said, "but you do need to be diligent and look for companies with strong fundamentals." Research shows that finding a 10-bagger can be life-changing. A study by Meb Faber found that investing in just a handful of stocks with 10x returns over a lifetime could lead to a 5,000% increase in wealth. For Lynch, the key was to look for companies that had a combination of strong management, a product that was in demand, and potential to expand quickly. Some of his biggest successes, like his investments in Home Depot and CVS, were the result of spotting these opportunities early. The good news is that you don't have to be a Wall Street insider to find these gems. Lynch's method was all about doing your own research and looking for companies with untapped potential. If you're willing to dig deeper, you might just uncover your own 10-bagger in the market. Keep your eyes peeled for emerging industries, growth in revenue, and companies that are revolutionizing their field. Chapter 6. Understanding risk like Lynch. How to protect your portfolio. Lynch's approach to risk was not about avoiding it altogether but managing it wisely. He understood that risk is a part of investing, but he knew how to protect himself from the downside. One of his key strategies was diversification. Instead of putting all his eggs in one basket, he spread his investments across different industries and sectors. By diversifying, he minimized the chances of a major loss if one stock performed poorly. In his book One Up on Wall Street, Lynch discussed how he held a portfolio of 1,400 stocks at one point, showing that even a large number of investments can still be manageable. "The trick to managing risk is knowing what you're investing in," he said. He always made sure to invest in companies he understood and believed in, which made him more comfortable with the inherent risks of stock investing. One interesting fact is that Lynch didn't just rely on diversification, he also focused on buying stocks with lower volatility. He looked for companies with predictable earnings and strong financial health. Companies that had stable cash flow, solid management, and little debt were less risky and had a better chance of surviving tough market conditions. According to a 2021 report by Morningstar, companies with low debt and consistent earnings growth are far less likely to experience steep declines during recessions. Lynch also emphasized the importance of having a long-term view to ride out market volatility. During his tenure managing the Fidelity Magellan Fund, he saw numerous market dips, but his patient, long-term approach allowed him to recover and thrive. He encouraged investors not to panic when markets dropped, as these periods often presented buying opportunities. As he put it, "If you're not thinking about owning a stock for 5 years, don't even think about owning it for 5 minutes." Lastly, Lynch advised investors to focus on their own financial goals and not get caught up in the day-to-day fluctuations of the market. "The best way to avoid risk is to focus on the fundamentals," he said. By investing in companies with strong business models and a good track record, you reduce the chances of losing money. Risk is always present, but with the right approach, it can be managed effectively. Peter Lynch's investment strategies aren't just for Wall Street professionals. They're simple, practical, and accessible for anyone. By investing in what you know, focusing on long-term growth, finding undervalued stocks, and managing risk wisely, you can follow in Lynch's footsteps and make smart, informed decisions in the stock market. Whether you're aiming for 10 baggers or just want to build a solid, diversified portfolio, his advice provides a roadmap for success. With patience, research, and a little bit of faith in your own instincts, you can become a more confident and successful investor. Make sure to hit the subscribe button for more insightful content on how to make smarter investing choices and grow your wealth.